Good afternoon, everyone, and good morning to our West Coast participants. Thank you for joining today's ICD webinar, Executive Compensation Trends, Key Learnings from the 2022 Proxy Season. My name's Scott Munn. I'm a partner with Hugessen Consulting, and I'll be moderating today's session along with my colleague, Michelle Tan. On behalf of the ICD and Hugessen, I'm in Calgary today, so I'm going to honor and acknowledge the traditional territories of the people of Treaty 7 in Southern Alberta, which includes the Blackfoot Confederacy, the Tsuut'ina First Nation, and the Stoney Nakoda. The city of Calgary is home to the Métis First Nation of Alberta, Region 3. We also acknowledge the enduring presence of Indigenous peoples on this land and recognize that today our attendees are located all over the country and on other Indigenous lands with applicable treaties or unceded territories. Today's webinar will run for an hour with a 10 to 15 minute segment for questions at the end. So let's begin. The webinar today has four main segments. We have the 2021-2022 business context and related issues, the key executive pay trends that we've noticed during our review of the 2022 proxies this year, the continued discussion of the continued evolution of ESG within executive compensation plans, sort of a double click on that topic. And lastly, a Q&A period. We probably have 10 or so minutes towards the end. So with that, please allow me to introduce my panelists today. Deb Starkman is the CFO of Dream Unlimited Corporation. She currently serves on the board of IM Gold Corp. And she has extensive experience as a financial and accounting roles, including serving as the CFO and corporate secretary of GMP Capital. Also with us today is Susan Jones, a corporate director who currently serves on the board of ARC Resources, CN Rail, Piedmont Lithium, and TC Energy. She has over 27 years of professional experience, including as the EVP and CEO of the Potash Business Unit of Nutrien. I'm joined by my colleague, Michelle Tan. She and I are partners at Hugessen Consulting. As you may know, Hugessen advises boards on board effectiveness, executive compensation, performance measurement and related governance, and alignment of ESG metrics in compensation. We work for a wide range of public and private companies in Canada and the US, and we're very pleased to actively support the ICD nationally, both with these webinars as well as with the Director Education Program. So with that intro, let's jump into it. I should add, pardon me, that we're joined today by Karen Wakefield on behalf of the ICD. So let's start the slides and talk briefly about the business context. Our first agenda item is really to talk about the market performance during the last 18 months and the current business climate, both as it affected 2021 and with an emphasis on what's going on in 2022 and might be coming to us during the balance of this year. Let's move to the next slide. So before getting into our findings, an important consideration is what we've seen in the stock market. Overall, stock market performance during 2021 was quite strong. But as we're well aware, we've seen a return to normal, if you will, or a decline recently in 2022. The trend has been mirrored and exacerbated across the NASDAQ, the S&P, and the TSX indexes. So what were strong reported returns last year have been generally given back over the last few months. Some sectors do continue to do well, notably the Canadian energy sector is up about 150% in the last year and a half. That's reflecting both the difficult 2020 as well as the COVID-19 recovery and the increase in commodity prices. So a stark contrast to what we saw in last year's presentation. Maybe with that, I'll flip it over to Susan and Deb to see if they have sort of any comments generally about the economic outlook and how they see that impacting businesses and in turn compensation programs. Deb, do you want to jump in?
Sure. Thanks, Scott. Good afternoon, everyone. I think there's just a lot of economic uncertainty right now. There's supply chain issues, rising costs, increased interest rates, and just a lot of issues that we don't know how they're going to turn out. There's a lot of market volatility, labor shortages, housing shortages, affordable housing. It continues to be an issue, and there's continues to be housing shortages despite what's happening in the market. So I think people are just a little bit uncertain as to what's going to happen over the next 10 to 24 months.
Susan, any additions?
Yeah, I mean, Deb's spoken to the uncertainty that there's no question. I'd say from the businesses that I see, I mean, as the energy index indicates, oil and gas, firm demand, given the dislocation of energy markets this year. In terms of movement of goods, rail and pipeline are very tight. There's little slack capacity and construction costs are high, lack of human capital. And all of this is leading to what Deb talks about is uncertainty in the second half of the year when you look at high inflation rates, interest rates rising and moving into a recession. So I think, for boards, what I'm hearing and what we're talking about is, ensuring that given any business you're in, that the second half of the year, you're not caught with a lot of inventory, high costs, and really just focusing on where demand destruction may take place as we move through the recession.
And capital preservation, I think, is also very important now, making sure you have adequate liquidity,
For sure.
Feels like directors have a lot to think about in an environment that's not nearly as smooth as it was a year ago. And I think that will come up in the discussion later on this morning. Let's flip to our first poll of the day. So just looking for the audience to quickly input your response to this question. What's top of mind in 2022? Geopolitical conflict, war for talent, inflation, stagflation, supply chain issues, other. Let us know what you think. We'll leave the poll open for a moment and then see what we get from the audience. So war for talent and inflation are the largest responses, followed fairly closely and evenly by the geopolitical conflict and supply chain issues. They're the first two categories around 50%, the next two categories at around 30%. Stagflation and other are quite low. And I do see in the chat, there's a certain amount of discussion that all of the above should have been a choice and it might have been well received. So appreciate that from everyone. On the other hand, it might have also masked the differentiation we were looking for among the different questions. So that's great. Moving on here to the next couple of slides.
Yeah,
Michelle, I think it's over to you to talk about TSX 60 compensation levels.
absolutely. And I would say from the polling results there, nice to see that the war on talent and how that plays into compensation and the human capital piece of what we're talking about here today really does come to the forefront. So it might be a little bit biased in terms of the attendees that we've got signed up for today. So the next section here, we are going to go through a little bit of the data that we've got in terms of key observations and the findings from our 2022 TSX 60 proxy review. So this is all built off of the disclosure coming out in 22 that was in respect of fiscal 21. And it really is focused in on some of the key trends here, CEO pay levels, some of the incentive design pieces, as well as the say on pay. So in terms of median actual CEO pay, and by that we're talking about the disclosed figures that show up in the summary compensation table here. Across the board, 2021 fiscal really was the year where this actual CEO pay did increase significantly for the most recent year, in fact, setting some record highs here in Canada across these largest cap companies. So over a 5-year period, the group of bars that are on your far left-hand side of the screen here, these are actually the incumbent CEOs of the TSX 60 companies. So those who have been around for this full 5-year period. So we're not getting any distortion here from the changing of the guard, a new and an old incumbent CEO. So really what we're going to highlight here is that over the 5-year period, we do have this compounded growth rate of 7%, a little bit higher than what it has been in the past, sort of in that 5% range there. For reference, we're also showing in the other two groups of bars here, the trend amongst both the same TSX 60 companies, so those who have been in this index for the full 5-year period in the middle section, and then those who have been remained in the index for the 5-year period, the CEOs who have been in that role within that sort of subset group for the entire TSX 60. So again, both of these groups show similar trends in terms of the big uptick in fiscal 21 on the actual pay levels. Sean, I wonder if you can move to the next slide. So this slide here, what we've shown is really the CEO compensation median on a target level here. Excuse me, sorry, a target and an actual level. Really the total direct compensation, which does include, just for those sort of newer to the area, base salary, the short-term incentive compensation, as well as the long-term equity. And that does include sort of the grant date value of those shares that are showing up in the summary compensation table. So looking at the TSX 60 as a whole, again, on the far left-hand side of your screen there, the target TDC did increase by 2%, whereas the actual, as you'll recall, sort of did increase significantly higher year over year. And while not shown here, I would say that what we did observe is that the variability of pay did remain relatively flat year over year, in the sense that the top quartile of the companies in the TSX 60 and the bottom quartile did decrease, so offsetting a little bit there. Amongst all of the sectors that we've sort of shown here and broken out into sort of smaller categories, we're seeing a little bit more modest increase in the materials sector at just 7%. And then the largest increase really coming in the financials, so the FI space coming in at 22% on the actual TDC. So while there's decrease in the target TDCs for the TSX 60 as a whole is significant, it's driven by two factors really that we can see here. The first being the methodology that we've used here, and that really comes down to some of the companies that don't disclose a target TDC. We've got a process for calculating what we mean by target, which does average the last 3 years of long-term incentive pay. The other piece there really is the changes in base salary and some of the foreign exchange rates impact that have had a significant change on the value here. And because of the sample size being relatively small with the TSX 60 and not all of the companies having an AGM within the January to June date, the median is a little bit more sort of subject to volatility across the data points. So just as a quick sort of point out here in the energy sector and materials, big sectors here in the Canadian market, we are noting that the decrease is relatively small, only 2% and 1% year over year. Susan, I'm wondering if you've got any sort of reaction to either the actual or the target pay levels that we're seeing across CEOs here in Canada?
Yeah, thanks, Michelle. I mean, to me, this isn't surprising. I think the actual payouts are reflecting of the market conditions we're in and what we're seeing with the overall backdrop. I think what I would say though is from the boards I sit on, this is leading into a bit of a different discussion, which is it's not only about compensation, it's also about what's keeping people at companies, because we're seeing a significant movement of people in the war for talent. And if you're just simply chasing compensation, it's a zero-end game. So really it's about the mission, the purpose, the culture. What are companies doing to ensure that people actually want to stay? So, if we're looking at this next year, I wouldn't be surprised if it's significantly higher.
Mm-hmm. Something to look out for. If we flip to the incentive design piece now, focusing on the short-term annual cash bonus here, there aren't a lot of headline changes, but a couple of the smaller observations. It's similar to past years, the TSX 60, truthfully, the financial metrics really do sort of drive the day. 55% companies do, and they're at 70, like over 70% of the overall weighting amongst companies. We are going to get into ESG a little bit later as a subtopic, but we are seeing that there has been an uptick in both the number of companies and the weighting of the weights for ESG metrics in the short-term incentive programs here. I'd also say that one of the big areas that we're seeing coming out of COVID really is a bit more weight and the prevalence of both the operational and the strategic metrics on the side there. On the right-hand side of the slide, what we've got here is the top sort of most common metrics Obviously, financial and ESG being sort of the key ones that we've honed in on here. But don't want to sort of lose the fact that some of the productivity, the cost savings, the net static growth, and sort of the strategic pieces as well, really coming from some of the uncertainty that we've seen and that we've talked about earlier in the performance conversation there. One of the things that was sort of very sort of standard, has not changed a whole lot. The number of metrics really has not moved significantly. So as some metrics are being added in, i.e. the ESG ones, they are being sort of done at the cost of some of the other operational or strategic metrics there. So that it's not that we're adding ESG and keeping all of the other existing ones. It really is a balance point for a lot of the balanced corporate scorecards. Deb or Susan, just wondering if you have any reaction or sort of thoughts here on incentive design.
Well, I guess I'll kick off and then flip it to Deb. I guess when I look at this, what I reflect on is that financial is still quite high. And, I think coming through the pandemic and now with the geopolitical uncertainty, there's a lot more discussion around other categories, technology and innovation being one, leadership being another. How can we keep scorecards balanced so that we can smooth out the highs and the lows for executive teams and really reflect what we're expecting them to do in these uncertain times? So, I would just say that maybe wider ranges may help, but also taking maybe a chunk out of that financial and recognizing what we're actually asking executive teams to accomplish.
And to add to that, I would say, agreed, financial is the biggest, but ESG is becoming more and more important quickly. It's also very important for investors. They want to make sure that companies have an ESG platform. Dream is very advanced in sustainability and impact. IM Gold is also, very focused on it, and there are metrics that the named executive officers and other employees in the companies are compensated based upon. But again, strategic is really important always, because I think it links to financial. How are the people managing the company? How are we managing our capital? How are we managing our costs? How are we managing, our client growth? So that would be my opinion. But again, I think ESG, the prevalence of ESG is growing and will continue to grow. And there's a lot of uncertainty. There's a lot that companies need to do by 2050. And how are they going to achieve that? It's very expensive. I don't know. Some companies are very advanced, but I think a lot of other companies have a lot of work to do in that area.
Really coming down to the trade-offs between those financial, operational, and ESG metrics. Really, what is our definition of performance and success holistically? Fantastic.
So we did a bit of work on how boards assess corporate performance over the last couple of years. And I guess ending in 2019, we had developed this blue histogram that you see that shows the range of corporate scores. These are for companies that have a 0 to 2 times performance multiplier based on corporate performance. And we just thought, for the audience sake, you'd get a sense as to how this got stress tested in the last 2 years. So 2020, which would be a historic low for the measurement period, came in at 0.96 times target. And 2021 came in at 1.33 times target. So order of magnitude, 2020 was roughly in the 30th, 35th percentile compared to history. Well, 2021 was at the 75th percentile. So Deb, I don't know if you have thoughts on this as to how boards were thinking of it, or what sort of might have been the setup for the recovery in 2021, but any brief comments there?
Yeah, thank you. I think there's a lot of uncertainty. As I said earlier, people are nervous about the economy in Canada, especially. And we saw a huge rebound in the stock market. Now we're seeing a bear market. We're just really not sure what's coming. People are there's just too much uncertainty, and we don't know, should we be investing? Should we not be investing? Should we be, obviously very, very prudent to manage capital, look at liquidity, look at costs, because again, there's so much uncertainty. And I don't think we've seen something like this in Canada before. I think in other parts of the world, perhaps we have. And, I think in 2008, when we didn't know globally if people would come in with a job. 2012 was the global, financial crisis. Now we have, 2008 was the global financial. Now we have a very uncertain time. We have really high interest rates. We have very high shortages of housing. We have labor shortages, and, to Michelle and Susan's comments before, there is a huge war on talent. And I think COVID has changed the way people look at work and the work-life balance, and just having a hybrid, approach. It's just there's just a lot going on right now that's hard to navigate.
It's interesting. We'll move on to the next slide in a second here. You enumerated some of the recent sort of macro crises that boards have had to deal with in the last few years. But, you go back to 2001, I mean, you just keep going, right? And you begin to appreciate that these events occur periodically and maybe more frequently than we care to remember. But it's part of serving on a board is dealing with these uncertainties. We just happen to be dealing today with some that we haven't seen in a while, and we'll talk about the geopolitical risk in a couple of minutes here.
And we also, just to your point, we also have to be prudent as directors about, using judgment to, pay out performance or something like that. We have to be stewards of the company. We have to look at what the scorecard says. We can't, got to be very careful about applying judgment when paying out, total compensation, or compensation that I should say is at risk, because, this is the economic environment we're in. When there's good times, people are paid very well. When there's bad times, this is just what happens.
Let's talk a bit about LTIP and sort of focus in on the changes there. And I'll be brief before I pass this over to Michelle. So relatively few changes in 2022 compared to 2021. We did see the continued sort of grind and decline in the emphasis on stock options. Just some examples: Cenovus and Nutrien reduced their weighting from 50% to 25%. Power Corp went from 50% to 1/3. Dollarama went from 100% to 50%. And Fortis eliminated stock options for the CEO and for the Canadian executives. So part of that was probably the change in taxation. Part of it was probably just the ongoing pressure. Frankly, the US market practice, where you see a lot less prevalence of stock options, would loom large too. TSR, as you can see, continues to be a very prominent metric. And on the other hand, the return measures declined a certain amount last year. So Michelle, over to you.
I knew it was going to happen. So hopefully you can hear me now. So I'm actually going to ask Tracy if she could load up the next poll for participants. So really what we're here, curious to hear about whether or not you are planning on revising either the performance targets lower for the upcoming year, considering the current macro environment that we are going through, supply chain issues, political, economic realities that are there. So I'll give you a couple of minutes, or at least a couple of seconds here, to answer that poll. And maybe while that poll is sort of ongoing, Sean, if you can flip to the next slide, we'll just cover off some of the Say on Pay results, what we've got up here. So in 2022, we did see a decrease in the overall results for Say on Pay, particularly those that are over 90% and those that are under 50%, so the prevalence of those ones there. The increase in Say on Pay say on pay results for those in the 80 to 90% range, and the no change really between the 50 and the 70% range there. We have seen in the most recent week a couple of failures come out, both at CI Financial and BlackBerry. In the case of one, it was actually the second year in a row that has been the case there. I would say overall, the say on pay results here, they do vary by industry, as you'll see in the groups that are off to the right-hand side of the screen here, with materials and the financials industry being the only two industries there that saw year-over-year increases in their results. Notably in the financials, I think there was a much bigger bounce back in terms of their financial strength and sort of where their pay and their TSR really did line up for the 21 fiscal year and the votes coming out of the 22 AGM. And so really saw some of those average say on pay results increase significantly when you go down into the weeds there. Whereas some of the other ones did see the decreases, maybe due to some of the challenges on the performance side, a little bit less so on the pay. Susan or Deborah, just in your terms of your experience on say on pay, any comments, reactions, thoughts for our participants on the always interesting say on pay? It does tend to get quite a few headlines from the media.
Yeah, Michelle, I mean, I think that, given, and Deb's mentioned this earlier, that, we're steward of the company capital, stewards for, all stakeholders. But what I would say is, given we've talked about all of the uncertain times that we're in, and I think what's really important is for boards to work with executive teams. I've talked about the balanced scorecard, ensuring that we are focusing executives on what needs to be accomplished in the next 1, 5, 10 years. And then ensuring that if there are going to be issues as it relates to say on pay, that that you're doing the right thing for the business that's sustainable. And then you actually explain why you're doing it to shareholders. And to me, seeing some up and down, you're still in the 90% range. And I know when it gets to 80%, it's, kind of red flag area. But I do think right now is the time where boards, we've just talked about the war on talent, boards need to ensure they get the best talent to ensure that strategically they're going in the right direction. And that could turn into a real opportunity. So I guess my message is just don't get so mired in say on pay and looking like we've looked in the past, because we're navigating uncertain times right now.
Mm-hmm. A great time to then bring up our poll from results of poll number 2. Tracy, if you could do that for us. So surprisingly, a bit of an even split, a third across the whether or not you're thinking about making changes to the performance assessment and or applying discretion. So 2 different ways to sort of potentially get to a similar answer there. So yes, no, very clear answers there. I'd say the biggest chunk of the 1/3 really is too early to say, given where we're at in this particular fiscal year, which is not necessarily that surprising. And I'd say that one of the questions that's come through on the chat function really is what we've seen in that use of discretion over the past 2 years that can hopefully guide some of the committees right here, right now. Susan or Deborah, I'm not sure if there's anything that you can share in terms of how you might have thought about the use of discretion over fiscal 2020 or even fiscal 21, how you went about it.
I think we kept it simple. We went along with better scorecard is. What are the corporate factors by which we're evaluating the performance of the company? I think, as I said before, I think we have to be really, really, really careful about exercising judgment. Mm-hmm. You don't want to be too cute or be doing something that, doesn't make sense. We have a responsibility, we have an obligation, we have to be compliant with what we're doing as the compensation committee and as directors of the company.
Yeah. And I just add, Michelle, that I do think that it goes back to the balanced scorecard. If you've taken time up front to properly assess where you believe you need to go in the times that you're in, then that will help smooth out some of the big swings And, the boards that I sit on, we didn't actually exercise discretion in 2020 or 2021. And really, it's a matter of saying, is our balanced scorecard doing what it should be doing?
Mhm. Yeah, and that lines up a lot with what we saw both in 2020 and then 2021, where the use of discretion was pretty heavy, a little bit more than majority of companies, both applied discretion up and down, I would say in both ways. Whereas in fiscal 21, significantly less, so almost close to, I think it was more of a quarter, so a bit half of what it had been the year
Michelle,
prior.
I have a question for you or for Scott. So just with respect to scorecards, do you see a lot of companies are basing it on adjusted measures, or do they base on actual measures? Because we know the OSC doesn't like adjusted measures. So I'm just curious as to what your findings have shown.
You want me to jump in?
Sure.
I would have, so in my experience and recognizing I live in Calgary, so I do a certain amount sort of in that natural resource area. It's whatever measure is the one that's going to be more useful to management and to the board as a measurement tool, which is usually the adjusted measure. And I think that just means you need to do a decent job of disclosing the adjustments, disclosing the rationale for using an adjusted measure versus an unadjusted measure.
Thank you.
I think maybe just a flip side of that as well, when we're talking about some of the ESG measures that are starting to come out now, particularly the leading ones there's not a good definition. There's not a lot of consensus or standardization around what a gap type metric would look like. So until really some of those ESG platforms and frameworks can get us to that standardization, we're going to see a lot of adjusted or very custom and tailored definitions for those metrics. So in terms of the next segment here, if we sort of keep this moving, we're looking to sort of talk about some of the emerging topics. It's already come up. We sort of mentioned it as we've gone through the first half of the webinar here, but really looking at some of the key takeaways from the proxy season, the growing prevalence of ES&G, as well as war on talent and the geopolitical uncertainty.
So Michelle, I think the biggest thing that we've seen is really this discussion about the war on talent and sort of the shift away from, or maybe related to, the Great Resignation. I know in our practice, we see it with financials, tech, law, just sort of all over the place, and a lot at the sort of junior and mid-level of the organization, as well as the top level of the organization. We've layered some inflation pressures on top of that now. And then we've got the whole work from home question. And I know one question from our clients is, if we're seeing salary budgets for the broader employee group, what do we do for the executive team? So a couple of different themes that keep cropping up. Deb, maybe pass it over to you to see if you want to jump in here, or Susan, on this particular slide.
I would agree, hybrid working from home, what that's going to be, the war for talent. And again, it's just, you're right, it is the Great Resignation. It's a really unusual time. And then, of course, the emerging topics and trends we've talked about a lot today is ESG and the impact of that as well.
Susan?
Yeah, I'd make a couple comments here. One is, I do think on the war for talent and working from home, there's a lot of discussion that takes place at the board level in terms of the companies themselves. But I do think we need to be looking beyond that to our suppliers and customers to say, what are they requiring in this environment? And how are we adapting to ensure that we're getting a competitive edge over other businesses that we're competing with? So, you can't ignore the fact that you want the best talent, but it's also what your customers and suppliers are demanding. And then just in terms of the geopolitical conflict, I mean, it's a risk on the one hand, but it's also a massive opportunity on the other hand. And, you could almost call it a generational opportunity if you think about how flow of goods and supply chains may change as we move through this. And so, a lot of the discussions that are happening at the boards that I'm on are, how will our business look coming out of this? Will there be an east-west divide? And how will the movement of goods be impacted? And so when we think about compensation, what are we doing to ensure that we've got significant targets related to this strategy? And, Deb's already mentioned that, how strategy is so critical as we move through this period.
Great, thank you. Back to you,
So
Michelle.
the next topic we were going to sort of dig into a little bit here is ESG. So we've got a couple of data points here. Before I get to that, Tracy, if you could load up poll number 3, which has the 2-part questions there. We'll let our participants answer that. So the first question is whether or not your incentive plan does currently have any type of ESG measure. And then the second question relates to where that might head in terms of increasing emphasis on these areas. So what we're seeing here in terms of the 2022 proxy season, really have seen over just the 1-year period, a fairly hefty increase in terms of both the number of companies that have disclosed new or changed ESG metrics in their short and their long-term incentive programs. And we're seeing that both in terms of the addition of metrics themselves. And for some companies, it's simply just increasing of the weight. So moving from a 5, 10, or even up to a 15% weighting of the overall balanced scorecard there. I would say we're also seeing that by now, most of the TSX 60 has incorporated an ESG metric of some type that makes sense and is material for their business operations and their strategy into their incentive programs, or in some cases have disclosed the intent to do so for 2022. So really the takeaway there is that not all companies at the top end here have done this. There are still a number of companies that are still in the evolution, still reviewing, considering, and figuring out how to do this exactly for themselves. When we think about the mid-cap and the smaller cap companies, I would expect, and certainly our experience with clients has shown, that a number of those smaller companies are a little bit further behind as well. And so these levels are probably indicative, but not going to show up entirely the same way across the small and the medium cap companies. We'll also just sort of let you know that amongst the approximately 20 or so TSX 60 companies, a fairly hefty number, that haven't incorporated anything into their incentive programs, 5 of them have actually disclosed that as a first step, what they have done is actually including these in the individual incentive components for their top executives. So that had been one of the questions in terms of the earlier participants that are loaded up on the chat feature. Where do we see the individual, and does individual show up in the short-term incentive programs? It does. It's simply not sort of prevalent. I would say there are some companies that do include a sizable component on individual pay or individual performance, but it's not widespread. And so that's why it doesn't necessarily show up in that balanced scorecard earlier on. Susan or Deborah, any takeaways here in terms of how you're thinking about ESG strategy, operations, incentive programs?
Well, I guess ESG is a big category, right? And I think that with the boards that I sit on and just discussing with other directors in the community, there's been a lot of discussion around GHG emissions, who signs on for net zero 2050, and not as much discussion around the S and the G, but I do think that, S and G are very relevant, and the GHG emission piece is certainly from a setting a target of some sort, whether it's 2050 or others, is almost table stakes now. And I think whether you're small, medium, or large, you really need to be putting your targets out there, but also not losing sight of, the social implications, in Canada, relationships with Indigenous groups, the DE&I, what boards are doing in terms of their own governance for their own skills matrices, in terms of, some of the large filers have come out with, a say on climate advisory for shareholders. And so kind of all of that needs to be taken into account. And I do think that it's really better to get out with metrics and get moving than to ensure that it's perfect. I did notice there was either a comment in the chat or a question as it related to, will ESG fall down now that we've got energy security, food security issues? And I think that what I'm hearing from executive teams in the energy sector is that shareholders are much more focused on energy security, but it's an and. It's not an or, and we need to be focused on both.
Deborah, any thoughts?
Oh, I would agree with what Susan said. I think also so we talk about climate, we talk about, safety. Another thing, if you're in financial services or an asset manager, it's, net zero asset managers initiatives, impact investing. Sometimes they're, the OSC and the SEC have certain regulatory requirements that are coming that companies need to think about. And there's principles for responsible investment. So it is coming fast and furious in many forms. And again, I go to what I said earlier is, how do you attain, the market desired level of involvement and disclosure at your company, given the complexity, the costs, and in the nature of ESG activities. It's very complex, and it's very difficult to determine how to manage it, especially with companies in energy mining that, it's a big issue.
Mm-hmm. It's certainly a heavy lift for the clients that we've helped work through.
Yeah.
The ESG issues, particularly the inclusion into the incentive programs once they get to that point in the process. Tracy, I'm wondering if we can bring up the polling results for poll number 3. So what we've got here, and we did ask these questions last year, and so we've got a pretty even answer, although more the majority in terms of no. I would say that this has actually come down significantly. So a year ago, we had almost 70% saying no, that they had not at this point incorporated any ESG measures. So that is certainly moving with the trend that we've seen, that more companies are starting to do this. And then pretty even again, sort of splits, possibly the majority in terms of, yes, we have had them, and we are increasing the emphasis both in the short and in the long-term programs where we've got them. I would say here again, the no's has come down significantly. So last year, what we saw was almost 55% at that point did not think there'd be any increase in the emphasis, either short or long term. And so that has come down by almost half at this point in time. But good to see sort of the trend in terms of the emphasis changing on both those short and long terms, not just one or the other.
It creates an interesting context for next year's proxy, right? We've got almost 400 people listening in today and voting from across the country. So likely a poll that's fairly reflective of the Canadian general industry. So that tells me that this emphasis on ESG is, has shifted from the large cap organizations to really all sectors of the market. And I see some comments in the chat related to nonprofits, related to social ventures. So it's really permeating the Canadian economy. So quite interesting. We have a couple more slides, which I'll go through fairly quickly, in part because they are also in other Hugessen webinars, so they can be found if folks are really looking for a deep dive, but also want to leave some time for questions because we got some good ones. So let's just talk briefly about short-term incentives and the use of ESG. We're really seeing it come into a couple of different ways. We see at Enbridge sort of I'll call it the bucket approach, where there's a emphasis on ESG and the measures are sort of captured all within one category. We have the discrete approach that CN Rail uses. So they have a weighting of 30% cascaded across 5 different measures, each with a 6% weighting. And then we have the modifier approach used by Scotiabank. So just for the audience, sort of 3 different ways in which ESG measures are being incorporated. There's obviously pros and cons to each. I think, Michelle, our client experience would say you have to figure out what's the best use for your organization and apply some thought as to sort of how to incorporate these measures into your performance measurement system, and think a little bit about how the committee is going to then judge the performance relative to those criteria. Moving on to the next slide is one on long-term incentive. So just as a backdrop here, we're seeing some use of front-ended conditioned long-term incentives. So how did you perform in 2021 determines to some degree the size of the LTIP award you see in 2022. And that shows up at some of the banks, Canadian Natural Resources, and CAPREIT, just to name a few. And then we're seeing ESG being incorporated in there. And here we have tech using that sort of discrete approach to look at how it influences the long-term incentive award at tech at this time. So just a couple of different examples. Maybe with that, if it makes sense, Michelle, why don't we jump over to the Q&A segment? Pardon me, key takeaways, then Q&A segment.
Yeah, I'll be very brief on the key takeaways. We've sort of like covered these over repeatedly a little bit here. I would say the number one really is like this uncertainty. How do we grapple with it? How do we deal with the budgets and the plans? And what does this mean really for the corporate performance? I'd say some of the key areas that we saw clients dealing with this early on is like getting updates from the management teams early and often in terms of how things are tracking, even if they are changing as the year progresses, to really be prepared for that year-end conversation. In terms of the war for talent, there's a number of aspects here. It doesn't necessarily show up in the scorecard itself, but really is becoming a bigger part of the human resource committee's agenda. And so much more time on the agenda for recruitment, attraction for new, and the hiring of new as well, and sort of how that plays into the overall people strategy of the organization. And then obviously, as we've continued to say for the last couple of years, the continuing evolution and emphasis on ESG, really sort of taking companies at their stage in the journey, where they're at in terms of ESG and sustainability, strategically and operationally, and then at the appropriate time, how and when do we get this into the incentive program? It is becoming a bigger ask for a lot of the institutions, the shareholders, and the proxy advisors out there. So I think now we're going to move to the Q&A. And
yeah, and there's one here that I've been looking at that I was hoping Deb or Susan would take a crack at. It's, will the realities of inflation, volatility, uncertainty, and possible recession move ESG down the priority list until the fundamentals are stabilized? And maybe it could be broadened to just how will this environment affect the thought process around ESG? I don't know, Susan, do you have any views there?
Yeah, look, I think for the here and now, people are focused on, supply chain, ensuring they've got the best people in the business and all that. But I do think, and it goes back to my comment on ESG is not simply a GHG emission reduction. It's this broader packet. And I do think that companies need to think of it as an opportunity and not necessarily a takeaway, and that there's a lot of opportunity out there. And I'll just give you an example. If companies should be focused on where they can influence the regulatory environment that they're subject to. So there certainly can be targets and a lot of time spent influencing regulators and or politicians in terms of how the world looks, and it should be done. I think that if you're not focused on that you'll see what happens in 3, 5, 10 years. But I just think we're so far along this road, we need to really be focused on all 3 of those metrics, and it shouldn't be falling down the priority list. But in the same token, it shouldn't be taking over the dialogue at the board and executive as well.
Yeah, great. Deb, you want to jump in? Anything to add?
I couldn't have said it any better.
Okay, go with that. So maybe I'm not sure who's best to answer this question, but there's a question around good examples of short-term incentive measures related to innovation. And so how do we get innovation on the agenda and how do we measure that? And where does it fit? Any takers?
Well, I'll jump in, Deb, and then you. Hey, look, I think it can be a number of ways, depending on the industry you're in, right? What percentage of your revenue do you have in R&D? Are you entering into partnerships in which you would be exposed to various innovation and technology in sectors that are maybe parallel to where you are or within your sector itself? And just generally, what is the activity that is going to affect the innovation in your sector? So from an energy perspective, you know, what's being done in hydrogen as an example. And, you know, I'm on a lithium board as well. What are the innovations as it pertains to electric vehicles, and what targets are you setting? What M&A activity are you doing? And what goals do you have to ensure that you're staying abreast and also infusing it within your business? So I think there's lots of ways you can do it. And I think that if companies that do incorporate some of that and actually chase some of that technology innovation should end up in a competitive edge down the road.
Okay.
Yeah, I think innovation is really important. I guess the question is how do you measure it?
Yeah.
Right.
And to that question, I might just add that sort of what we often see is more of a focus on the inputs into innovation. So the dollars, the effort, the time, and the actions that are in this area, rather than necessarily the outputs on it. So really the success of it is what we're trying to drive, but trying to find that needle in the haystack, it can be difficult. And so really trying to drive the actions and the behaviors tends to be a big focus for a lot of companies.
I think we have time for a couple more here. There's one around the war for talent. War for talent requires more focus on human resources area of the scorecard. The question is, why is it not showing up? Maybe I'll turn that around to how might that show up within the scorecard, and how might the boards get more focus on that?
Well, I mean, if I think back, you know, just 5 years, a lot of the compensation committee's time has been taken around compensation itself, right? Now there's a lot more discussion around pipeline. You know, you've got the CEO and their executive team, but also who is behind that, and do we have the right team set up for success in our new reality versus the reality that we've come through? So, you know, I do think that metrics as it pertains to, this is where you get into, you know, DE&I, cross training, you know, training, talent succession planning, all of that should help. That's what I would offer.
Right. It gets, I think, a lot to the board's increasing role in culture, right? You know, employees don't necessarily come to you for what the company does, but for why the company does it and what its purpose is, right? So it goes back to that mission and vision of the organization and why employees, broad-based employees I'm referring to here, want to be employed in a certain organization. And how is the board keeping the management accountable for evolving that culture over time?
Yeah, and I think at that point you can, obviously there's lots of ways to measure that with, you know, absenteeism and, you know, the percentage of employees leaving, and what are you doing to ensure you've got top talent in the organization, all of those things that can actually measure satisfaction, including, you know, employee surveys, et cetera.
Okay. Michelle, there's a question here on the guidelines and the use of discretion. Do you mind taking a quick crack at that? We've got a couple minutes left. I knew that you would get this question from clients regularly, so go for it.
I'd say there's no guidelines per se. There's definitely some first principles that we would suggest are good ones to go by. And certainly from a director perspective, it is knowing what it is you're trying to do, having a very good sense of your views on the performance of the company. So hearing and seeing what management's saying in terms of where the results really did land. Does it feel like this was the right answer? And so trying to assess that a little bit more holistically than just sort of, here's what the numbers put out in terms of the actual scorecard number. I would say on the flip side as well, what we're also seeing is a huge amount of effort, not just on landing on the use of discretion, if and how and what we would apply it to, but then also the articulation and the communication of it, not just in the proxy for the external shareholders and whatnot, but also internally to be able to say to the organization and communicate that message that we understand there is or isn't certain challenges here, and here's how we view them, and how the senior management team really has been held accountable for the actions that were within their control. And so really that diligent on the front end, doing the work to understand where the results have landed and whether discretion is or isn't necessary, and then being able to articulate that final decision for all stakeholders, really a key component.
Okay. Do we have time for one more question?
Maybe one quick one.
One quick one. So there's one here on should boards consider leading indicators versus lagging indicators for pay decisions on executives? So maybe I'll genericize it a little bit to how should they consider leading versus lagging when they're thinking about executive performance?
Deb, over to you.
I was going to say over to you.
Happy to jump in with the generic
That
consistent
would be
answer, that it
wonderful.
really depends on what it is we're measuring, financial, sort of operational strategy, ES&G, how comfortable you are with metrics, your ability to stress test and model what the results could or should be, what the expectations really are, and what the strategy is that you are trying to drive. And so there is a place for lagging indicators. There's also a really big case for the leading indicators. And I would say that sort of an overall holistic balanced scorecard and long-term incentive plan needs a combination of both of them.
Yeah, that's where the
Said it better.
context. Yeah, that's where the context of the individual organization or company matters a lot, and figuring out where it is or what it is that you're trying to encourage management to do, and what is that emphasis on leading versus lagging. And then to your point, all the issues about strategy and how you can measure it. Michelle, with that answer, I'm going to pass it back to you to wrap us up.
Yeah. And I'm cognizant that as soon as you get the consultants answering your question, the quick question becomes a little bit longer. So we are definitely at time at this point. I would really like to take the opportunity to thank our co-panelists here, Susan and Deborah. Thank you so much for your time and energy. We do hope that participants that you enjoyed the session today. The presentation, the slides will be available. They'll come out from the ICD. And for those of you who have submitted questions that we didn't get to, didn't have the time to address, we really will endeavor to get those answers provided to you as part of our follow-up coming out of this. For anyone looking to stay up on top of this particular topic, feel free to check out the Hugessen website. There are links up on the slide at this point in time. And on behalf of the ICD, Hugessen, and our guest speakers, as I lose my voice here, thank you again for joining us today.